co-living is here to stay. It's required due to an affordability constraint. It can't just be co-living. So our platform is focused on two things, and I distinguish them. One is called social living, and the second thing is called co-living. And the social living aspect doesn't mean having roommates. It means creating a community within a multifamily building, right? So usually you see traditional multifamily buildings that are very sterile in the sense that, you have kind of lackluster amenities, and then you have a bunch of apartments with a nice lobby. We're trying to turn that on its head and sit there and say, why can't a high-rise building be a community? Why can't it be the coolest, most desirable place to live? What do the people who would typically live in a place like this look for? Okay, well, they look for things like in our South Florida properties, for example, we have a couple of them now, expansive sort of pool decks and a very social kind of amount of space. The gyms are not tiny little apartment gyms. They look like an Equinox, and they have trainers and yoga classes and things like that. We do a lot of programming, what I'll call. So it's not just a build the spaces. It's also animate the spaces, have whiskey tastings, have different functions that bring people out and sort of promote the sense of community.
You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth.
Hello, I'm Deidre Woollard, an editor at Millionacres. Thank you so much for tuning into the Millionacres Podcast. If you followed this podcast for a while, you know I love talking about how real estate impacts the lives we lead. And one thing I found really interesting in 2020 was that it changed, perhaps temporarily, how people feel about the places they live. So today I'm chatting with Sasha Cucuz, the CEO of Greybrook Securities, which is a Toronto-based firm that invests in development and value-add properties. And Sasha is responsible for co-managing the firm's operation and investment strategy. Together with his partners, he's played a role in growing Greybrook's real estate investment portfolio to include over 80 multifamily and residential development projects throughout North America. That means over $17 billion worth of estimated completion value. And under Sasha's leadership, the firm currently manages over $1.2 billion of equity on behalf of more than 6,800 high net worth individuals and institutional clients located in over 30 countries. So thank you for joining me today. I'm excited to get your take on the future of large developments, because before the pandemic, we saw a new development really focusing on shared amenities. So what I'm wondering is that sort of amenities war that we saw in large cities over now?
Firstly, thank you for having me. Obviously it's been an interesting year. I think that the idea of cities and sort of overall, their demise is something that's incredibly overstated in my mind. I can't begin to describe how overstated I think it is. And I don't say that facetiously. I just think it has to be, it has to be kind of reinforced, because what we're kind of seeing today is something, in our investment strategy, we think a lot about urban context and sort of household formation and things like that. And one thing that helps us is to think about factors that drive systemic change and factors that cause disruption, and how to distinguish those factors, and not to undermine the severity of this global pandemic, because of course it's been, severe in health and people's wellness, obviously, and also the economy. But the one thing I will tell you is that, historically, we can look back centuries and see how cities and urban context has persevered through difficulty. And I think that this, in my mind, is not different. Human beings inherently are social creatures, and they require sort of community, and they require having access to each other and to different amenities. And it's part of our daily lives today, whether you live in a large city or whether you live in a small town. And I will tell you that, in some of the larger cities across North America, the particular nature of this pandemic has made it such that we have to take a pause in many respects. But I don't see this at all as a systemic shift in the way we think about our world going forward. I think that once the immediate threat has been neutralized by whatever means that is, whether that's vaccination or otherwise, I really feel that people are going to kind of revert back to what they have known for many decades in terms of urban living, and the reasons that brought them to cities in the first place are the reasons that will bring them back to cities going forward.
So you don't think the lavish gym and the lounges and any of that is going anywhere?
I don't. I mean, I think that there's certain behavioral changes that will, survive this pandemic. And as we think back, when we're sitting here with our future selves, thinking backward to, the pandemic, there are certain things that I think naturally will say, oh, okay, that was obvious that this would kind of change. People are more acutely aware of their environment than they were before. They're acutely aware of air quality. They're acutely aware of what sort of impact a viral load can have on their health, but also on what it's done to society and the economy at large. And I think that awareness and living through that is going to change certain behaviors permanently. But I really don't subscribe to the notion that we're going to see big amenity spaces, gyms. I think people will be back to those activities. I think that they'll be back to working out. I think they'll be back to retail in whatever form that takes. Another part of the narrative today is talking about how nobody's ever going to walk into a retail store because Amazon, has made it easy for everyone. I think that's true to some degree. I think there's been an acceleration in the Amazon effect, so to speak. I think that retail will have its place like cities and other amenities.
Well, of course, Amazon's also getting into the grocery store business, so they definitely see the value of physical space as well.
No question.
So, in terms of low rise versus high rise, one of the things we watched in 2020 was that there was more of an interest in sort of smaller developments versus those large vertical ones. Is that something you saw as well?
We had a bit of a mixed experience. So we develop in Canada and the US. We develop in what I'll call mega cities, places like Toronto, fourth largest city in North America, as well as in large cities that aren't in the top 10, places like Fort Lauderdale. So I'll tell you that we saw a bit of a different response. In places like Toronto, there was a much higher demand in the low-rise market, and it was driven primarily by two factors. I think one of the factors was the fact that people can work from home, and they were spending so much time at home that they started to reconsider whether their current space was sufficient for what they were looking for in their lifestyle. And then the second thing is, cities were largely shut down, here in Toronto. So big office buildings in the core, they were closed, for business. People were asked to work from home. And because of that, the nature of development is such that low-rise development typically happens more in the suburban areas of a megacity, and the high-density, high-rise development happens in the core. And of course, you're going to see that demand shift because the core was largely closed. So very few people are thinking, man, this is the best time to go live in Toronto right this second. I'm going to spend all this money and I'm going to move there, and then I'm going to be sitting in my living room because there's nothing to do, no one to see, nowhere to go to work. So I think there were some obvious drivers to that here. Now, I'll tell you that in South Florida, we saw a little bit of a different reaction. We have a large-scale social living / co-living development in Fort Lauderdale called Society Las Olas, and it's right kind of at the foot of the riverfront there in Las Olas being the main kind of drag there in Fort Lauderdale. And right when the pandemic began, we had just started our lease up program. Now, if you could pick timing, that probably is the worst. In our minds at the time, we were very nervous because, man, we just started leasing up this giant building, and this pandemic hit, and everybody's talking about staying away from one another and social distancing. And the whole context of this building was to promote a social environment, right? It was meant to create kind of a community within a high-rise building. And then the second component of it was co-living. Since mid-March, when we launched this leasing program, we've been ahead of pace relative to our forecast and expectations. So frankly, there was no impact as far as we were concerned on people's appetite to rent in this type of building. I'd say that there were a couple factors at play here. Now, here you're seeing the difference between a Toronto and a Fort Lauderdale. Well, Fort Lauderdale is in Florida. It's sunny. There's no state income tax, so the cost of living is a little bit different than in big cities. And now people in big cities, particularly in the Northeast, have been told that they can work from home all year. And they started to sit there and think, maybe this would be a good time to experience something different, right? Particularly that rental cohort that's a little more mobile, right? Generally, because of their age bracket, they're, typically between kind of 23 and 35. Of course, lots of people rent, but that's kind of the main demographic that we attract. People were taking the opportunity to say, I may as well go live in Florida, outdoor space, different cost of living, maybe a better quality of life. And one of the things that our co-living product provides is affordability, because it gives you that urban proximity with all of the amenities, but because of the size of the spaces, it's affordable at when it comes to, sort of people's budgets to be able to live at, in the city with that type of lifestyle. So I think that affordability aspect really attracted people to it, notwithstanding, that there was a global pandemic happening. I think it didn't really deter people at all. So we saw a little bit of both worlds, to answer your question.
Well, it's interesting because you're a Canadian-based company, and the New York to Florida commute is something that we've been watching for a few years, and I think it's accelerated during the pandemic a lot. Goldman Sachs is moving to Florida. I keep hearing Wall Street South in the news, so there's a lot of conversation about that. How long ago were you started investing in Florida, or is this a last couple of years thing, or was this something you've sort of been watching the tea leaves on this?
Yeah, I think watching the tea leaves is probably a good way to describe it. Our first investment was in 2014, and my partners and I had been, kind of tracking South Florida and other states. It's not just about Florida, but Florida was a particular interest for us, starting back in 2012 and 2013. So we had been watching it for a number of years. We've been participating now for 6, going on 7 years. And what brought us down there in the first place, when we see this narrative of, Goldman, other hedge funds, none of this comes as a surprise to us. And our investments have been specifically made in the city of Miami, not so much Miami Beach, for this specific reason, because we've seen we forecast in at least in our views macroeconomically, we're forecasting an urbanization of places like Miami because, again, the state of Florida has a lot to offer people in addition to good weather. I mean, it has a great sort of quality of life, a good cost of living relative to certain other states. It has, a very diverse employment base. And South Florida in particular plays another unique role, which is it's really a bridge market to some of the emerging South American economies. So the services that American firms can provide to, high net worth South Americans, for example, wealth management, accounting, legal work, and things of that nature, make Miami a natural sort of home base for some of those companies due to its sort of cultural diversity and its link to South America. On top of that, when it comes to states like New York, there's always been a historical relationship there. And, Miami's a cosmopolitan place. South Florida is very diverse from an arts and culture perspective. So it gives you the ability in a very quick sort of 2-hour plane flight, the ability to, sort of be in a warmer climate and still have the access to amenities and cities that you would in New York City. So we've been looking at it for a very long time. So to see this happen is kind of validating our thesis in the first place. So when we were making our investments, they were really focused, as I said, on the city as opposed to kind of the beach area. And some of our investors up here in Canada said, well, that doesn't make any sense. Everybody wants to go to Miami Beach. Why are you guys buying, land in areas that are underdeveloped at the time, like Wynwood and sort of the core, the central business district of Miami. And my answer was pretty simple. If we're right about commerce moving and Miami being a hub, then the people who live and work in Miami on a daily basis are going to want the same things that a New Yorker would, or somebody from Chicago or Toronto. They're going to want proximity to their employment. They're going to want a live, work, play environment. And candidly, the beach is interesting to people like me who are going there on vacation, but maybe not so interesting to the 29-year-old lawyer who, has a busy work schedule and has a social life and things that they want to have easy commute proximity to the city rather than being on the beach. And if you know Miami at all, the distance from Miami Beach to the city of Miami might not be a lot in terms of miles, but getting there in rush hour is a different story. And I don't think people want to be spending 50 minutes in their car. It's only the people that are going there for leisure that are really focused on the beach. The people that are going to be living there for work, have different priorities.
That is very true. The other issue, too, I'm wondering if you also considered was sea level rise and climate change. Certainly, Miami is one of the cities in the U.S. that's going to be most impacted by that. And I've already heard that some areas, some low lying areas, they're not doing 30-year mortgages on houses and things like that.
Yeah. I mean, look, I think environmental sustainability is something that over the past decade has become very important for real estate developers. For many years prior to that, it's been an important societal issue. But again, sometimes real estate developers can be a little slower in the uptake. And really, I think it's mattered a lot more. And I'll say it's mattered in a couple of different ways. One is, as you point out, Deidre, the obvious is places like Miami, where you have to consider its near-term impact and what that might have on real estate. And when you're kind of choosing sites and locations, it certainly does enter the sphere of reasoning when you're selecting these locations. So you have to think about proximity to the ocean. You have to think, and it's not just climate change in the sense of rising water levels, hurricanes, things like that. So you have to think about those things. The second area where I think over the last decade it's become a lot more topical and pervasive is in just general environmental sustainability when it comes to construction. Thinking about durability, thinking about using sustainable materials and sustainable methodologies is something that's always been an important feature for us. And I think, as we go into the future, this dimension is only going to become more prevalent and something that, real estate developers have to think about.
Well, let's go back to talking a little bit about Toronto because you're based there. Greybrook's invested in a wide variety of properties in the Greater Toronto area. I feel like the U.S. kind of doesn't know as much about how vibrant a city Toronto is. So, could you explain a little bit about why Toronto is such a great place to live?
That's my favorite question because as a proud Canadian and proud Torontonian, I'm eager at the opportunity to tell people about this city and how great it is. I've lived in the United States. I've lived in New Jersey, for a couple of years, and we have some businesses that we invest in as well that are not real estate related, that are healthcare related. We invest in some other things that are headquartered in, Northern Virginia and different parts of the United States. So I spend a lot of time in the U.S. It's a great country. I love spending time there. And one thing about Toronto is that I think over the last 5 years in particular, there's been a lot more awareness in the United States about what Toronto is and how Toronto fits into kind of the global perspective. And I'm not sure if it was the Toronto Raptors winning the NBA championship that got people to really notice, but Toronto over the course of the last decade has surpassed Chicago in terms of size. Los Angeles. So Toronto now is the fourth largest metro area. I believe it's New York City, followed by LA, and then Toronto kind of fits right in there in the top five, right? So it's the fourth largest city in North America. We have some 6.5 million people in our kind of metro area here, and it's really become a global city in every sense, from the cultural and sort of leisure aspects, professional sports. We have arts, theater, and everything that you would expect in a large city. We have a very, very diverse population. People from all around the world, and what that's brought to a place like Toronto is different cuisine, different experiences. Not unlike a San Francisco or a New York, we have a Chinatown, a Little Italy. It's an incredible city, and I think the construction and development here in response to sort of population growth, because we've had somewhere in the order of magnitude of 150,000 net new people coming into Toronto every year, which is an incredible level of growth, and that's kind of necessitated a lot of construction and a lot of diverse construction. It's not simply one type of housing. It's high rise, it's low rise, it's semi detached, it's fully detached, everything from skyscrapers to mid rise buildings. And then all of the office development to go along with that as job creation has been very consistent. So, if you look at a photograph of the city of Toronto back in 1993 when the Toronto Blue Jays won the World Series, and you look at it today, it's like you're looking at two different cities. You wouldn't recognize them if not for our landmark CN Tower. And it's all as a result of sort of very open and sort of prescriptive immigration policies and a very diverse employment base that's driving people to Toronto and the surrounding area. And there's been an incredible benefit to the people here.
And it's also been become a place where there's a lot of tech startups. A lot of founders are now drawn toward Toronto versus being drawn to Silicon Valley. I know Google had the Sidewalks Labs project. That seems to have hit up against some local legislation and maybe isn't going to be as large as it was originally going to be, but certainly an interesting construction project too.
I think that the emergence of the tech sector and the gig economy has really brought a lot to Toronto. It's diversified our population base. It's sort of when it comes to tech in particular, it's really brought an energy to the city. Amazon just announced that they're taking more office space here in Toronto. Shopify, a large retailer, doing the same. Google has an office here in Toronto, and they've announced a campus just outside of Toronto here in southwestern Ontario, which is our province. So there's a lot, and what that's done is it's brought a demographic to the city that is young, energized, and really looking to be involved. And I think it's made our city a much better city. Now, when you reference Sidewalk Labs and what they were doing here, I think what they were doing here was tremendous, but very ambitious. And when you're kind of doing things at that scale, of course you're going to have participation of different levels of government and some of those challenges to deal with. And I think saying this in a positive way as an investor, frankly, some of the difficulty in moving large scale projects forward in a city like Toronto when it comes to the government's participation and standing around regulation and sort of around development specifically, there's a lot of collaboration required, brings forth a scarcity, right? So I think what's made Toronto a great place to invest in is the fact that you have this tremendous amount of growth, which of course fuels demand for housing. Yet at the same time, it is not a free for all. You can't just build to your heart's content. There's a lot of regulation. There's a lot of interaction required with municipal and provincial governments, community members, and stakeholders. And it makes it very difficult to produce housing. So that makes for a great investment climate because very high demand and a limited supply obviously has an impact on price, and it usually has an upward pressure on that price. So very similarly, to see what Sidewalk Labs was trying to do and how much collaboration it took, it's really not surprising to see that there's challenges and nothing that can't be overcome. But at the same time, I think that we have to look at some of those plans and maybe think about them in chunks rather than this grand vision that was presumed at the forefront.
That brings me to another question is that I feel like because you're a Canadian company, but you're also developing in the US, you have this sort of window into the construction processes in both countries. And, in the US, we had a little bit of a scramble last year with different places calling different types of construction essential versus non essential. Had a little bit of a slowdown and then kind of a sudden pickup. What did you see from the different countries, how construction played out in 2020?
The caption that everybody talked about, we're all in this together, wherever you were in Canada or the US or global, was really true in the sense that the impact we saw in Canada was very similar to what we saw in the US, and the reaction was very similar in both of these markets. And I would say that that's not typical. Like typically, there's differences between them. For example, here in Canada, I think construction has a big seasonality to it, especially in colder markets. When you're building a giant high rise and you're 60 stories in the air, temperature can sometimes affect your pace. Places like South Florida, that's not an issue. Conversely, in South Florida, you have water level issues and you're not digging underground to do foundational things. Everything's done on sort of piles that are driven into the ocean floor. And here in Canada, we don't have those issues. So there's a lot of differences, but I'd say that the response relative to the pandemic was very similar. Construction was deemed to be essential kind of across the board, at least in our asset type, which is residential. Well, frankly, because it's residential, people need roofs over their heads, and if those homes are being built, odds are somebody's waiting for that home and have made plans. So those were deemed to be essential services. Anything that was kind of what we'll call above grade construction, so things that were either on their way to completion, not right at the beginning of a process, for example. And the second thing that we saw that was consistent. So initial reaction was there was a bit of a pause because nobody knew what essential meant and how you had to introduce safety protocols to sites. It wasn't just get back to business as usual. It was you had to think about your people first and foremost, and how to make them safe and comfortable and make sure that there was social distancing protocols and other safety protocols put on site. That was kind of uniform across Canada and the US. Once things got up and running and people were clear on process and protocol, as an example, when I talk about protocol, the first week, if somebody coughed on site, everybody went home. Like it was like, screw this, I'm not going to get COVID. And nobody knew what to do. The site super would call and say, do I tell them to stay? Like there was no playbook for this, right? But then obviously, people kind of work together to try to figure out what the best practices were, to try to figure out with public health experts what protocols had to be put into place, what was reasonable, what was not reasonable. How do you keep people safe, but how do you keep the economy moving forward and within that construction? And that was pretty consistent across the board in Canada and the US. The last area, I think, where we saw a change and consistency, both in Canada and the US, was a little bit of a disruption of supply chain, right? So, certain things did move slower, right? Just by nature of the fact that other services that were not deemed to be essential were closed, and some of those included manufacturers of, door handles, for example, right? Okay, well, that you need it. It's just going to take you a month more than it did before to procure them. So, I'm using that as kind of an example, but all of this to say that there were certain parts in the supply chain and with material costs as a result of that sort of were kind of both impacts, and it happened both in Canada and the United States. So all of this to say that in two markets that are usually very different, we saw the impact of the pandemic being very similar across the board, and we saw the industry's reaction to it also being quite similar. I guess when you're both being impacted by a set of even circumstances, you're going to expect some of that. But it was surprising a little bit for me to see that.
Interesting. Thank you. Well, this is a great place to take a short break.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram @Millionacres and on Twitter @Millionacres_co.
During our break today, we are excited to have Millionacres lead investment analyst Matt Argersinger here to speak briefly about one of our newest services, Real Estate Winners. Thank you for joining us, Matt.
Thanks for having me.
So what is Real Estate Winners and who is it for?
Well, I like to think of Real Estate Winners as our answer to Stock Advisor in the real estate market. It is a service that provides recommendations on publicly traded real estate investment trusts and real estate companies. So it's a pretty big universe out there. There's over 200 REITs to choose from, and probably dozens, if not hundreds, of real estate companies are in our universe. And we provide regular investment recommendations as well as commentary on the market, educational material. And it's really designed to get anyone who's interested in investing and learning about real estate started.
So is it geared toward new investors or is it more for seasoned pros?
I think Real Estate Winners can serve both. I think if you're a new investor, maybe you're just getting started with stocks and you want to learn more about how to add real estate to your portfolio, great place to start. If you're a seasoned investor and just thinking, okay, how can I diversify my portfolio, maybe reduce the volatility in my portfolio, maybe add some income to my portfolio, then I think Real Estate Winners is a great solution for that cohort as well.
Fantastic. What are the benefits of being a member of Real Estate Winners?
Number one benefit is day one when you join, you get our top 10 investment ideas at the moment. So really right from the beginning, you know what our 10 best ideas in the publicly traded real estate market are. And then going forward on a monthly basis, you'll get a new recommendation, sometimes more than one new recommendation, as well as regular content that we're coming out. We're covering our past recommendations, providing updates, and talking about the real estate market. So it's really the full package.
Perfect. So what do you need to get started?
Really all you need is a discount brokerage account. So if you're used to buying stocks, and you probably already have that. If you haven't bought stocks in the past, of course, just open a discount brokerage account. These days, you don't even have to pay commissions. It's fantastic. So it really couldn't be easier to get started investing with Real Estate Winners.
Sounds fantastic. So how can people sign up?
Sure. They can head over to real.fool.com. That's real.fool.com.
Great. Thank you so much, Matt. I'm back with Sasha Cucuz of Greybrook Realty Partners, and we're talking about development and the future of housing. And so I know you have an interest in co-living. You mentioned the Society Project in Fort Lauderdale. Co-living has certainly been a topic of discussion in recent years. I'm seeing both positive and negative things. WeWork's We Live program, that didn't work out so well, but you've got companies like Star City continuing to expand. Where do you fall on the co-living debate right now?
For me, it's not a debate. I think this is unequivocally part of the future. I'll make an analogy that's a stupid but smart analogy all at once. When talking about it internally and describing it, I said once, what did you think that the sitcom Friends was? It was adults who couldn't afford to live in New York. They were all gainfully employed, but very expensive city, who had to kind of live together to make it work. So the concept of roommates and having roommates in expensive cities, and cities are just becoming more expensive by virtue of the fact of sort of, population expansion and more employment intensification into the cities. You're seeing prices rise. And when you look at prices rising in most urban centers relative to household income, those two charts look very different. It's a much steeper increase in price than what you've seen in increases in real wages. So what that's doing effectively is decreasing the purchasing power for folks. And if you want to live in cities and you want to have proximity and all of the amenities a city brings, including proximity to your employment, you're kind of running out of options. So where co-living kind of comes into play here is effectively what I'll call automating or just sort of making turnkey, for lack of a better way to describe it, an experience with roommates. It's doing it intelligently. And I think I'm not going to comment on WeWork or anyone else's platform because that's not my place to do that. But I can tell you that from our perspective, being a developer rather than a co-living manager are very different things, because it starts with your design and how intelligently you can design your spaces and amenity spaces and figure out that right mix of amenities and figure out that right suite mix for the, everything from a 1 bedroom to a 3 bedroom kind of co-living space, and everything in between. And if you do that well, I think that the product stands out. So our philosophy is two things. Well, three things. One, co-living is here to stay. It's required due to an affordability constraint. Two, it can't just be co-living. So our platform is focused on two things, and I distinguish them. One is called social living, and the second thing is called co-living. And the social living aspect doesn't mean having roommates. It means creating a community within a multifamily building, right? So usually you see traditional multifamily buildings that are very sterile in the sense that, you have kind of lackluster amenities, and then you have a bunch of apartments with a nice lobby. We're trying to turn that on its head and sit there and say, why can't a high-rise building be a community? Why can't it be the coolest, most desirable place to live? What do the people who would typically live in a place like this look for? Okay, well, they look for things like in our South Florida properties, for example, we have a couple of them now, expansive sort of pool decks and a very social kind of amount of space. The gyms are not tiny little apartment gyms. They look like an Equinox, and they have trainers and yoga classes and things like that. We do a lot of programming, what I'll call. So it's not just a build the spaces. It's also animate the spaces, have whiskey tastings, have different functions that bring people out and sort of promote the sense of community. So that's a hugely important piece, because I'd say people come to the Society platform not just for the affordability play that co-living offers them, but in addition to what they're spending on rent, they don't need a gym membership. They don't need membership to some of the social clubs. We have co-working facilities in many of these buildings, so you don't need a WeWork membership. Nothing against a WeWork or somebody else, but these things are available to you within your own ecosystem, in your own neighborhood, as we'll call it. And as a result of that, it's all included in that rent check, and it considerably saves on those expenses. So it's not just an affordability play on the space, it's an affordability play on the lifestyle within an urban city. But then you have to animate that and make it exciting for someone. And where our focus is on the co-living side is not having these buildings exclusively co-living. They have a traditional mix, and they have a percentage of them that are dedicated to co-living. So the idea being that when somebody's 25 years old and they come in there with some roommates, if they love that neighborhood, if they love that building, there's room to grow. And you can go from a co-living suite to a 1 bedroom to a bachelor, to a 1 bedroom, to a 2 bedroom, and beyond that. So it's really meant to be a community more than anything else. So I think the answer to your direct question is co-living is here to stay, but it's about finding the right recipe. And obviously biased, but I like to think that our Society platform has done that.
Well, I do think that there is a place for that sort of all-inclusive living, and I think that's very attractive to people. So let's talk about Greybrook's acquisition process. How do deals usually reach you, and how do you decide what's right or not right for your company?
That's a great question, and I'd say it's changed a lot over the years. I would say so. Our business is about 16 years old since we started it, and in the first few years, it was a very proactive process. So what I mean by that is we kind of had a good thesis on what it is that we wanted to invest in. And then we went out and tried to find good partners. That was step one. So it's not about finding the property to develop. It was about finding the right execution to partner with on the ground. And that is the most critical factor. And in the early years for our organization, it was about establishing those partnerships. And that was kind of the primary focus. Beyond that, once we entered into those partnerships and had some things to develop, it was about supporting them and being a great investor. And for us, that meant two things. One, being a great steward of capital for those that have entrusted us with their investment, making sure that we're always putting their priorities first and managing their risk against the opportunities. And then the second thing was being a good partner to our execution, because our philosophy had always been, if you write a check to a developer and you're just an equity source, then you're just an equity source. And tomorrow, once somebody gives them better terms, they'll go elsewhere. We wanted to really add value to these platforms. And it wasn't just about writing them a check. It was about really understanding development and hiring a team of asset managers that can add value to this, to the development process itself. So we very much collaborate with these partners in co-developing these properties. So what that's done, and this is how it relates to acquisitions, is through forming kind of 20 or so partnerships with large scale developers over the course of years. Deal flow for us today is very much organic, in the sense that we're not out there knocking on doors or trying to find new partnerships. It's the partnerships that we've cultivated over many years. As they're out there looking at their pipelines and what they have next, they bring them forth to us. So our deal flow today is a very captive ecosystem that exists within the 20 partnerships that we have. Obviously, we're good business people, so we're not closed-minded to establishing new partnerships. But at the same time, our primary focus is to service the partners we have, and it benefits investors in the sense that there's a level of comfort, there's a level of what I'll call practicality to execution. You could spend all the time in the world negotiating a deal with somebody or terms of an investment, and it looks great on paper. But where the rubber hits the road is when you start living day to day and making decisions. And, it's invaluable when you spend time with some of these groups. You know how they think, what type of character they display as an organization, and you develop a trust. And I think that's the first and foremost thing we offer our investors. It's not about finding a new deal or a new partner. It's about working with the people that are reliable, that you can count on, and that's something we focused on.
That makes a lot of sense. Good partners are hard to find sometimes, but essential in real estate. So, on the other side of the equation, how do investors reach you, and how do you determine who you want to work with on the investor side?
Yeah, that's a great question. I mean, when we started, our investor base consisted of my partners and I, and like our parents, and any relative that we could get to trust us at the time, because we didn't have a track record, and we were new to it. Fortunately, we had some people that were willing to take that leap of faith with us, including some people outside of our immediate families, obviously. But then, I think we earned the ability to have them reinvest with us through success. So that kind of grew over the course of years, and today we have almost 7,000 private high net worth clients and institutions that invest with us. But we're always looking for new investors. And I get that question a lot, which is, well, you have a lot of investors, you have a lot of capital at your disposal. Why are you looking for more? And the answer is quite simple. We do things on a deal by deal basis. We're not a fund, and we do it specifically so we can customize opportunities for people, right? So if today an investor got a hold of me, Deidre, you said, look, I want to make an investment with you, Sasha. I've got $100,000. What project should I invest in? The first thing our folks would tell you is, don't put $100,000 in a project. Let's talk about how we can create a customized exposure that fits kind of what you're looking for, like what your investment objectives are, what your risk tolerances are. We can create some diversification through different geographies. We develop kind of throughout North America, high rise, low rise, different cities. There's a mix of things that you can include, and maybe split up that $100,000 investment into four $25,000 investments that give you a broader, more diversified exposure. So when you take that approach, really having access to capital through individual investors is kind of the lifeblood of our business. So we spend a lot of time trying to reach out and make ourselves known to people who are looking for alternative strategies outside of their typical stock and bond portfolios, which are important. We're not looking to displace that. We're looking to be augmentative to that. And if it's a portion of someone's portfolio, what we look to do is try to work with them and create a customized exposure to what we're doing. So all of this to say the way people get a hold of us is through many different mechanisms. Whether it's sort of online, a lot of people can find us on the internet when they're looking and doing searches. They see, everything from seeing signs on hoarding when they're driving by developments, like, okay, who are these guys? And they look us up, right through to the relationships that we have in place. Our biggest source of new investor introduction is our own base of investors, right? They've had success. They've had a good experience working with our capital markets team, and they recommend their friends and relatives to us. So that's kind of how our business has grown, and that's why we're in 30 different countries. I get that question a lot, which is, how the heck did you end up in 30 different countries? We didn't have proactive strategies to be in 30 different countries. What we did was, through Toronto's own sort of multicultural ecosystem, where we have people from many different cultures and backgrounds and countries of origin, when they invested and had a great experience, many times they'd refer people, from their family and friends that maybe are from the country they're from. And then next thing you know, you develop a relationship there, and all of a sudden you have a number of folks from there that are now investing with you. And that sort of, happened over the course of a decade and a half. So, we're always on the lookout for new investors. The way that people qualify, I'd say, is we focus primarily on accredited investors. It's a certain classification of investor, and it's probably getting into the weeds of sort of securities law, but that's where our focus is. But I will say this, that there are different types of people that can qualify from big to small. We're not looking necessarily for, people investing millions of dollars. It's in some cases, people investing $25,000, to $50,000 that are saving for retirement. It's a question of what's appropriate, right? It's what's appropriate for the individual. It's not a one size fits all. When you're dealing with somebody who doesn't have the financial bandwidth of, sort of a mega wealthy investor, you're really doing the same thing and trying to craft the same exposure, but paying particular attention to their specific situation, their liquidity in other areas of their life, how quickly and readily they need access to this capital, and what their risk tolerances are. So we're kind of equipped to deal with everybody from large institutions. We have people we have institutions in our capital base with hundreds of millions of dollars invested with us, and then we have people with $25,000 invested with us.
Great, thank you. So we talked a little bit before about the construction environments in the U.S. versus Canada. The lending environments in the U.S. and Canada are pretty different. Can you explain a little bit about that and how they differ?
I'll tell you, there's sometimes there's a difference. There's two levels of difference that I'd sort of highlight. One is in the conservatism, I'd say, of Canadian financial institutions. So, your typical sort of Schedule I bank here in Canada has very rigid criteria, and they're not really willing to go outside the lines at all. So there's a very prescriptive process when it comes to financing rental buildings. There's a very prescriptive process when it comes to financing condos, and those ratios are different between those two, but they're always very consistent. So you always know exactly what you're getting and what's available to you. So when you're the equity like we are, it's always a very defined formula, and you kind of know what you're getting. I'd say in the United States, there's a lot more diversity in terms of lenders and people who fit differently within that capital stack, as we call it in the real estate business. So, you have your senior debt, which would be kind of equivalent to kind of our lenders here, the bank lenders here in Canada. But then you have a lot of other players. You have mezzanine finance sources, you have pref equity sources. So you can be a lot more creative with how you layer your capital into a project, all depending on sort of what risk tolerance you have as an investor. Like we don't like to take on too much debt. We like to kind of stay, very equity heavy in our development. Sometimes people would say we sacrifice some upside in terms of equity multiple in order to protect and preserve our downside. So we're conservative in that fashion. But I'd say that the biggest difference, as I point out, is just a lot more diversity in the U.S. And then the risk, the rate environment is a little bit different between the two countries. So I'd say that, for example, here with a great covenant in construction, you could be anywhere kind of LIBOR plus 150 basis points. In the U.S., it's a little bit wider because of sort of the perception of risk around construction. So, really rate and sort of availability of different sources of capital are the two biggest differences, and really driven by Canada's relatively small market for debt. Right. And I don't mean small in terms of total dollars available. It's just in terms of number of players that you want to be doing business with. And I say that last part, that you want to be doing business with, when you're a developer of any size or scale, you don't want to go to exotic places for your debt, right? You want to stick to the big players, and that's what you need to do to be successful. So we're the type of firm that sticks to the top tier lenders. We're not going into second tier or third tier lenders. We stick to kind of the big banks here in Canada, and that's where we play. In the U.S., there's just a lot more large and credible players that play throughout the capital stack that just gives you that additional diversity.
That makes sense. So when I was doing the research on Greybrook, I noticed that you've invested in Delos Living. I've been following that for a while because they're major players in the sort of health and wellness real estate connection, which I find fascinating. I feel like this year and the COVID pandemic has accelerated everybody's interest in wellness. So can you explain a little bit what Delos is and why you wanted to partner with them?
Absolutely. So Dalos is a New York-based company. I call them kind of the world's foremost experts when it comes to healthy buildings, to put it simply. If you think about in real estate and development, a tremendous amount of focus over the past 2 decades has been spent on, certification programs like LEED, for example, which are tremendous and important. They fall short in the sense that I shouldn't say fall short. They focus, because that's been their focus, on environmental and sustainability factors as it relates to construction and development and buildings. There was really a void in how buildings affect human health, right? And when you think about the fact that we spend 90% of our lives indoors, it's almost insane that there hadn't been an equal amount of attention paid to how the air you breathe, the lighting, the water systems that are used are all interacting to kind of promote human health. And what Dalos has done through its wholly owned subsidiary called the International Well Building Institute is they've developed a certification program called the Well Certification. It's about 8 years old. They've invested several $100 million in the development of science-backed, evidence-based recommendations and solutions for how buildings should be built in order to optimize human health. And it's about a decade, as I said, in the making, 8+ years. We have experience with Dalos dating back to 2015. So not pandemic driven in that sense, but the pandemic certainly opened people's eyes to the critical nature of healthcare in the interior environment of a building. People didn't think about, the ventilation systems, what are they like? Are they good? Are they bad? Are they, able to remove pathogens? Are they meeting the highest standard of filtration? None of those questions were asked before, and obviously the pandemic has precipitated that question. And we think that the reason we decided to invest with and partner with Dalos was quite simple. We have an extensive portfolio of development today that's underway, and we want to incorporate all of these aspects into our day-to-day processes because they're important and they matter. And they mattered for us for a long time. It's just people didn't agree. And now all of a sudden, I feel that they do agree. In fact, they ask and demand. So we're in a great place in that regard because we've kind of been at the front edge of this together with Paul Shayla, the founder of Dalos, and his brother Peter, and the organization that they built. So, it was a natural fit for us. We think we can bring a lot of strategic value to that organization through our development portfolio and the relationships and ecosystem we have within real estate. And, I think that it was well overdue. So the pandemic really caused people to have to pay attention to this. And we're glad that, in something that's been so negative overall for the world, this paradigm shift for the future and how people are thinking about their own wellness, particularly within real estate and construction, I think will be a positive in the long run.
Absolutely. I think everyone focused more on HVAC last year than they had in previous years. So you mentioned the well certification. What else does that include besides things like air quality?
Really what it's doing is it's looking at sort of a building and its interior environment on a holistic and very comprehensive level. So it's looking at things, obviously air quality, it's looking at water quality and water quality management, so water filtration systems. It's looking at lighting systems, so use of circadian lighting systems, for example, and different types of lighting systems, as well as various biophilic elements as well. So it's really focused on sort of putting together and harmonizing, if you will. I don't know if that's kind of the best way to describe it, but it's not any one factor. It's about connectivity in the whole environment, in the whole building. And what that should be doing and is designed to do is to really promote the way you feel and what impact that has on your health. And I'll tell you, the way that we kind of started out this journey is it might have been back in 2015. I was sitting in the offices of CBRE, so CB Richard Ellis, huge company, their Canadian headquarters. And I was sitting there because I was meeting with a gentleman who we do some work with, and he was making me wait. So I'm waiting in his lobby, and I'm sitting there having a coffee, and I'm looking around thinking, man, I really like this office. Like, I don't know why. Like, it's not the design. Like, it looks kind of simple. Like, it was nothing flashy. It was not, but I really like it for some reason. I couldn't put my finger on it. And the receptionist said, okay, he's ready to see you. So there was a flight of stairs I had to walk up. So I walk up the flight of stairs, and as I'm walking up and past the kitchen, I can't help but feel, I know it sounds kind of hokey, but this actually happened because I'm not a hokey guy. I actually felt like, yeah, like there's something about this office. I really like it. We sit in the boardroom. He comes in, and I said, you know what, Paul, I got to tell you this. This is my first time at your office. You usually come see me at my office. I really, really love this office, and I can't tell why, but I do. And he said, don't know if you've heard of the WELL certification, but we WELL certified this office space. And of course, by that point, I knew what the WELL certification was. I had never actually been in a WELL certified space. And then we went into more detail as to what I couldn't put my finger on. It was just a combination of things. It wasn't any one thing. It's not like I was looking at a great sculpture or something that made it look fancy. It was the harmonization of the type of lighting that they used, the design around windows to promote sort of natural light in different areas. It was about sort of the common spaces and how they were laid out. It was about obviously the air quality, which of course I didn't know at the time, but obviously very high air quality. And all of those things working together made it a really pleasant environment to be in. So I walked out of that meeting and I'm like, you know what? This isn't BS. Like this thing is not just some certification that you do to put a sticker on it. I actually felt a difference here. And that's, where we felt that we wanted to really infuse this throughout our own portfolio and take it even broader.
I love that. So, one last question as we wrap up. Who do you admire most in the real estate industry right now, and why?
Well, I feel like I should answer that question two ways. So my wife works in the real estate industry. She, in fact, works here at this firm, and she's been a tremendous asset. So I admire her. She's going to like to hear that. But in the vein of answering the question, the way that you intended, I would say Bruce Glatt, who's the CEO of Brookfield. Brookfield is obviously a large asset manager, probably the largest in the world when it comes to real estate holdings. I think Bruce is an incredible leader. I think that he has a really, really firm handle not only on the state of real estate today across many asset classes. Like Brookfield does everything from infrastructure through residential construction and everything in between, every single food group. And just having sort of a very forward vision to understand sort of the trends in the real estate industry, not just in one market, but multiple markets around the world. And organizations like Brookfield, I think, are ones that really shape, the way the industry moves into the future. And I think he's a really great leader in that respect.
Interesting. He came up when I asked someone on our team recently the same question. So that's two recommendations for him. Thank you so much for your time today. Just a note for listeners, you can find more information on Greybrook Realty Partners at realty.greybrook.com, and that's GREYBROOK.com. Thank you.
Thank you, Deidre.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss that Millionacres or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.